Today we have George Gammon live in the studio. Coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver company specializing in strategies to help you navigate the reset that we are already walking through. But most importantly, look at who's here today. It's George Gammon. And we've been having some fun, haven't we?
We have. You're nice enough to come out and give me a tour of your urban farm, which is, I have no words.
It's kind of surprising, isn't it?
It's incredible. It really is. I don't think there's anything like it on the entire planet. Definitely not in Phoenix.
No.
That's for sure. Because you think of Phoenix as the desert and cactus, and you go over to your place, and it's just like the Garden of Eden. It's like, and I said it's like Jumanji. Remember the one with Robin Williams? Where you got the jungle, you've got pomegranates, you got nut trees, you got fish growing there, you've got quail running around, you got live ducks. I mean, it is really, really something special, that's for sure.
Well, so are you, and I'm really glad that you came today.
Well,
and I know that people have been asking about the video of the car ride.
Oh, yeah. Yeah, so if you want the inside scoop on Lynette Zang riding in my 500 horsepower muscle car and me just gunning it, putting it to the floor, you've got to subscribe to probably my Twitter, and that's where I'm going to put that out, clips of it. But you know what I think I might do?
What?
The next time I interview you for my channel, I might have the editors edit in clips of you like freaking out.
Well, you know, those cars were coming up to us, the ones that were stopped in front of us. I thought, okay, I want to see my granddaughter turn 6.
They're getting really, yeah.
But it was a lot of fun.
It really was. So, I guess I can't wait to dive in and start asking or answering some questions, huh?
Absolutely. But before
cool.
we get to that, so if you have any questions, just send them in through the live feed and Dylan will put them up. But I did want to start with this little headline that was buried in part 2 of the, because Treasury lose status as safety net for investors.
When did they have it? They lost it.
Well, supposedly the 10-year Treasury is the foundation of the global financial system.
Well, it is, but I'm saying for safety, I mean, my goodness gracious, when you look at the Fed's balance sheet and how much money, I mean, it's going parabolic.
Absolutely.
Right? And if you think at some point in time we're going to have inflation above 2%, and you're buying something that, pays under 2%, I mean, you're going to take a whipping for sure, unless the Fed can peg the yield curve. And we were talking about that earlier.
Do that, of course.
They take rates negative. I mean, there's a lot of variables out there. But my mantra is you buy things when they're cheap and you sell them when they're expensive. Well, we all know that the yield on the treasuries, there's an inverse relationship between interest rates and the yield. So right now we're at 5,000-year lows on interest rates, which means that Treasury prices are at 5,000-year highs.
Exactly.
So there's absolutely nothing right now cheap about Treasuries. So I'll leave that to the Wall Street Journal. They can go ahead and buy them, but as for me, no thank you.
Well, let's take, you brought up inflation, and that, it depends on what you look at. If there are things that you don't want to buy, well, that's pushing the inflation level down. But actually, in fact, I just did a piece on this yesterday where you look at the things that you have to buy, your food at home, etc. I think the average, looking at the top 10 states, are somewhere around 9% inflation. So, the Fed creates the benchmark on which they're going to gauge inflation, but they don't put in real world things.
Right. Yeah, for sure.
So if you then buy Treasury bonds, you're retired, and you want to be, well, I don't view them as safe anyway because they're debt. but you are definitely behind the 8 ball.
Yeah,
without a
because
doubt.
the reason you buy an asset is to increase your purchasing power or
Exactly,
maintain your
or
purchasing
maintain
power.
it, right.
Yeah, for sure. So if you're buying something that's paying you 2% and the real rate of inflation on what you buy or what you need the purchasing power for is running at 10%, then the delta between the 10% and the 2%, that 8%, is what you are losing in purchasing power.
Exactly.
So you're almost guaranteed to lose money if you hold it to maturity. It's like Jim Grant. He's calling them what is it, return-free risk, and I think that's a great way to describe them.
Exactly. And that wasn't risk return, that was return-free risk.
Yeah, instead of risk-free return,
Right.
it's return-free risk.
I love
Boom.
it. I love it.
Got to give a hat tip to Jim Grant.
Yep. Well, you could. I love him too.
Yeah.
All right. So we've got a lot of questions coming in, and Eric asks, what are your thoughts on buying multifamily apartment buildings in hot markets?
Yep.
Good time, bad time? Does COVID or future pandemics influence your decision?
I think it might influence my decision-making process, but that wouldn't be the first thing that I'd try to figure out. So the great thing about real estate is it's a very inefficient market. It's not like gold. If gold is trading at $2,000 an ounce, you can't get someone to sell it to you for $1,000.
Right.
It's not
exactly.
Yeah, there's no real discrepancy there. It's a very efficient market. But with real estate, you never know. If you get someone that likes you, or they're just crazy, or I mean, I've been in real estate for 8 years, and I can tell you some incredible stories. You could get someone that will sell you a $200,000 home for $150,000 or $175,000. If you know how to negotiate, you find a motivated seller. That's an example of an inefficient market, and that's why I like real estate. Now, so if you could find an apartment complex that there, for whatever reason, there was a motivated seller where you could come in and add value to it through a rehab, if you had that skill set, then it's something that I would consider. Then if you wanted to keep it long-term in a portfolio, you've got to start asking questions like, what type of neighborhood is it in? You know, it's always about location, location, location. And then you've got to look at, well, what's my return on investment compared to what? Then you have to ask yourself what type of debt you can get, right? Because most people look at real estate as an investment in the underlying asset. Where today, I think you need to take a multi-dimensional approach, because yes, it is about the underlying house, but I think that if you can secure that house, as an example, with 30-year fixed rate debt at, let's say, a 3% interest rate, you're really going to make more money on the debt than you are on the asset itself, because you're paying it back with cheaper dollars.
Exactly.
You know, when we go through inflation or a great reset, what have you. So that it's really, there's a lot of cross currents there, to say the least. But then going to the latter part of the question, this is when I come down to COVID, the pandemic, and kind of what's...
And rent moratoriums, too.
Moratoriums.
What about that?
Yes. See, with multifamily, I don't know that you're getting that through Fannie and Freddie, and I think the moratoriums were just through Fannie and Freddie, but I could be wrong.
I think they weren't across the board. They were with government agencies.
Yeah, so it all depends on what type of loan you have. But in
Right.
the future, I mean, that could definitely come down the pipeline. Who knows? But going back to the latter stages of their question, they're talking more about 2020 specific with the pandemics. I would consider riots and looting as well. So if I'm looking at buying an apartment complex that's in an urban area, such as Chicago, such as Los Angeles, Baltimore, there's no way. There's absolutely no way I'd touch it. And now, if it was in a jurisdiction where there was a lot less likely for there to be some sort of, let's call it social unrest, then I would consider it more. So I think you kind of go in the kind of, there's a progression there where you start by asking yourself those first questions, then you end with kind of what's going on with 2020, and that's how you come to the conclusion as to whether or not you want to buy or maybe pass.
Right, and I'd like to add, and I probably should have added it when we were first talking about it, because you were talking about looking for things that are undervalued. And, you know, the only thing that I see, frankly, that is undervalued right now would be, well, there are two things, gold and silver, because those two things were not targeted for reflation, so in terms of dollars.
Yeah.
Then when you put that with a mortgage, if you had enough gold in your portfolio because it's severely undervalued, then you can pay off that mortgage down the road when we go into the reset.
Yeah, because the mortgage is denominated in dollars.
Exactly.
Which are now, which will be most likely, especially 10 years down the road, worth a lot less.
Exactly.
And that's why it's so important to fix that fix that interest rate if you've got real estate. That's for sure.
Exactly.
Yeah, but one thing I'd like to add too, because I get the question all the time, is gold cheap right now? Because they look at the nominal price and they compare it with 2011 when we were at the top of the last bull cycle.
Right.
And what they need to do, or what I would suggest they do, is not just look at the nominal price of gold, but and then the next step is you have to look at it inflation adjusted. But then you should look at the real rate of inflation, going back to what we were talking about.
Exactly.
But then in addition to that, I would layer over the quantity of money.
Exactly.
Because if you look at, let's just call it M2 money supply, or broad money. So that's the amount of currency units that are in the real economy chasing a specific amount of goods and services, right? If you look at, let's say the price peaked out in 2011 at 1900, and let's just say that's where it is today, right? Well, the money supply back in 2011 was way
compared to where it is today.
It's way down there.
Right.
It's just way down there in front of us, and now it's way up there. So if you're saying to yourself, okay, you're buying gold with those dollars, with those currency units, and you're potentially selling the gold in the future for those currency units, you have to compare those two things side by side in order to do a complete analysis. And I don't think enough people do. I think they just look at the nominal price or the inflation-adjusted price.
Right. Well, and they know when they meaning the central banks and the governments, when they set the system up, that people don't understand inflation and what not at all. And what you're really talking about is the fundamental, the true value of an ounce of gold, particularly for its primary function, which is to hold its value intact over time.
Yeah, right.
So you can look at the manipulated price, which is what you're talking about, the spot price. That's a contract. And as we saw in March and April, we got a little teeny taste of what happens when the real price of the physical is divorced from the contract spot price. That's just a little teeny taste.
Yep.
So, yeah, I agree with you. Not many people really look at that. And there's an easy way to do it, too. And, you can just go to the debt clock, frankly, because money's created from debt.
Yeah.
So that will give you an indication of how much money is out there. And when you look at gold, there's a finite amount of gold.
Yeah, and also, too, I'd add to that right now the Fed is having to monetize almost 100% of the debt. So they're having to create brand new currency, at least base money, at least. And who knows whether that will translate into broad money, but that's a different topic. But so what happens when the federal government comes out and they issue a new, let's say, $100 billion worth of bonds? Well, they have to have a certain interest rate that we know is very, very low, right?
Right.
So if there are no buyers at the interest rate, then the Fed has to come in, and it's actually the primary dealer banks doing it, but it's just a shell game. It ends up going to the Fed's balance sheet.
Right,
anyway.
exactly.
So the Fed basically has to buy those treasuries. So if you look at a chart of the buyers of treasury, call it the private sector, that's pretty, whether it's foreigners or domestic, that's pretty much flatlined over the past year. Where you look at so you say, well, who on earth is buying these treasuries? And then you look at the Fed's balance sheet, and it's going parabolic.
Yep.
That means that the only buyer of those treasuries is the Fed. Now, the reason that's important is because if the treasury sells to the private sector, then they're taking money out of the private sector, right? So it's just circulating money.
Right.
But if the Fed buys those, then it's additional money. Right? And so you look at that, and then you look at their balance sheet, and then you look at the price of gold, and you're like, okay, wait a minute. Now this makes a lot more sense than it did just 30 seconds ago, right? And then you have to ask yourself, well, what is the Fed going to do in the future? So right now their balance sheet is at $7 trillion, let's say. Now, if you believe that the Fed can unwind their balance sheet, then number
Well,
one, I think you're
there's
crazy.
a bridge in Brooklyn.
Yeah, exactly. Or we've got some oceanfront property in Arizona here that
Yeah,
I could
well,
sell
we
you.
may at some point.
Right, but there's just, well, let's look at what happened when they tried to do quantitative tightening in the past.
Exactly, didn't work.
Right? No, they were up at 4.5. They got it back to what, 4, and then just the bottom fell out of it. So they had to come back, and now, 6 months later, we're already at 7 trillion. So it's very unlikely. There are no certainties, only probabilities.
Right.
But it's very unlikely for the Fed to be able to unwind their balance sheet.
Yeah.
That means that we're stuck with as much money supply as we have right now. And if we see velocity tick up, that means that inflation goes up, nominal GDP goes up as well. But you run into this scenario where then interest rates would most likely go up, but they can't have that because that's going to crush the economy.
Exactly.
So what's the only way that you peg rates is for the Fed to buy more treasuries and
Right.
to print more money. So that means that the probability, in my opinion, and I think you'd probably agree, is that the Fed's balance sheet is just going to go up and up and up and
Yep.
up. And therefore, you've got to own one of the only things out there that has no counterparty risk, that's something that maintains your purchasing power, that would be a form of money, in my opinion.
Well,
And
it
there you go,
is.
precious metals.
Exactly. And you've heard me say this a million times. If you don't hold it, you don't own it.
There you go.
Because if you don't hold it, you've got a contract and you're running counterparty risk.
Yeah, that's right.
So it is actually pretty simple.
That's right. So there's my long-winded
No,
question.
that was
We go off on
great.
a tangent, and that's what I always do.
Oh,
I
but
always
this
go
is
off on these
fun.
tangents.
I'm so glad you're here. Really, yeah. I love you. I love you.
All right, we got
Okay.
another one?
So
I'm trying to figure out
should
where
I-
the questions are.
Well, should I
Oh, you
sell
got
my
'em highlighted.
house and rent until something changes in the markets?
Well, it depends on the RV ratio that you can get with the house that you're trying to buy. That's how I measure if it's a quote-unquote good deal or not. So I always try to go for a 1% RV ratio. What that means is that the amount of rent per month equals 1% of your cost basis. And that's just kind of the way I measure it. So if you buy a property for $100,000, I want to get $1,000 a month for rent.
Mm-hmm.
That's a 1% RV ratio. You'll notice is if we get down to 0.5, then it becomes more and more financially attractive to actually rent when you do all
Right,
the math.
exactly.
So that's kind of where I'd start, is I'd look at the RV ratio, and if you're not getting a good RV ratio, I don't care when it is, I wouldn't buy it. So that's where I'd start. And then, I think the question really pertains to, okay, I'm worried about the housing market collapsing, so should I buy
Right.
now or should I wait until the housing market collapses?
Right.
The,
People ask that.
what you have to really understand with that question is that let's use 2008 to 2006 to 2012 as an example. Okay, so the housing market peaked out in 2006.
Yep.
It bottomed out in 2012, but if you look at a nominal chart, it didn't go down that much. It just kind of
Right.
had a bit of a dip, right?
Right.
But if you look at a chart adjusted for inflation, in 2012, we went all the way back to the same prices that we had in 1998.
Oh.
Which, by the way, if you adjust for inflation and size, are the same prices that we had in 1900.
Oh, interesting. See, I didn't know that.
So for
This
almost
is great.
100 years, the housing prices in the United States were the same when you adjust for inflation and size. Most people, they don't understand that. So my point is that usually in a healthy market, the housing market only goes up with the rate of inflation. It's very
right.
similar to wages in that
Mhm.
aspect. But then what you have is then it just went parabolic. Of course, we know what happens.
Right.
But then, so my point is, from 2006 to 2012, it goes all the way down to its historic trend line adjusted for inflation, right? So if you can go in and if you can get a price, or if you can get a house now for that type of price because of it's an inefficient market, then go nuts. I think you should look at pulling the trigger. But if you can't, then you hold off. And if you're thinking about in the future buying at a lower nominal price, you have to sit there and do this thought experiment where could we get to a point where prices in real terms, adjusted for inflation, go back down to where they were in 2012, but nominal prices continue to go up. right? And so that's what most people don't think through. So let's go through this thought experiment.
Okay.
So we've got a house that you're considering buying right now for $100,000, and it's going up at 10% per year. But the rate of inflation is going up by 20% per year. You see, although the house is going from 100,000 to 110,000, you're actually losing purchasing power. So a nominal chart would show prices going up, but a real chart would show prices going down.
I see.
You see?
Oh, really?
So you have to think that you're this person, if they're wanting to find a property that's quote unquote cheap, or if the housing market is quote unquote cheap, you need to look for the prices that we saw in 2012 adjusted for inflation, not just in nominal terms. So we could have a real crash while nominal prices are still going up. It's kind of a long-winded.
So where would you find that information, though?
Well, yeah, you have to look at a chart going back to 1900. It's one that I use on my whiteboard videos all the time. You can actually just Google it, and it'll come up. But you'll see there's a distinct line there. There's a trend line that we came down to in right around 1998. And then back in 2012. So if you had to ask me where home prices were going in the future, just as an aggregate total in the United States, I'd say we're going right back to our historic trend line, right? But that doesn't necessarily mean that housing prices go down.
Right.
In nominal terms.
In nominal terms.
Yeah.
Yes.
They just might go down in real terms.
That's really interesting.
So that's why it's so dangerous to sit there and say, well, I'm going to sit back and wait till the housing market crashes, and then I'll go ahead and buy. Might not crash.
Yeah. If we go into hyperinflation, maybe it won't. But, and then again in Japan.
That's a great example. Well, let's look at Venezuela.
Right.
So did the housing market there ever crash? Not in nominal terms. In nominal terms, the houses are worth 100 million times, literally more than they were worth prior to their hyperinflation, denominated in their local currency. But in dollar terms, or in purchasing power, they actually would have gone down.
So anybody that's holding, in Venezuela.
So if you're in Venezuela, let's say, if you are waiting for the housing market to crash because you see the government doing all these crazy things with socialism that you think is going to cause hyperinflation or is going to destroy the economy, you'd still be waiting.
Right.
And you never would have bought, and you never would have picked up that mortgage at a fixed rate.
30 years.
That you could have paid back with a loaf of bread 10 years, or not even that in Venezuela, 2 or 3 years.
Or an ounce of gold.
Yeah, exactly. So, and when I say a loaf of bread, I know that might have thrown someone for a loop. What I'm saying there is that if we get into a hyperinflation situation, the amount of your debt stays the same. So if you take out that $100,000 loan on your house, then you need to pay back $100,000. But in 3 years, $100,000 might just buy you a loaf of bread.
Right, exactly.
You see?
Yes.
And that's why I'm saying you pay off your house with something equivalent
with
to
a loaf of bread. Right. And part of the strategy is to pay it off with gold. You're buying the gold now, so you take out a mortgage, but you make sure that you have enough gold over here to pay it off.
Yeah, right.
And then when it goes into the reset, what might take you, 100 ounces right now could maybe even take you a tenth of an ounce then.
Yeah.
Depending upon what that cover ratio
yeah,
is and what that looks like.
As you know, I spend a lot of time in Colombia.
Yes.
And in Colombia, their 50,000 peso note is about $12, roughly, $12, $15, something like that. So I always, or not always, but sometimes on my live streams, I'll take one of the 50,000 peso notes and hold it up to the camera there, and I'll say, do you think that they started with 50,000 like that? They said, let's see, something right around the value of lunch. Let's make that 50,000 pesos. No, they started with a 5, and then it just another zero, another zero, another zero, another zero. So why can't the dollar do the exact same thing? Why can't we have
actually?
But why can't we have a $50,000 note in 5 years, 10 years, 20 years, whatever, that only buys you lunch?
Exactly.
It's the exact same thing happened in Colombia.
Yeah, you're exactly right. Okay, well, let's see. Blue Lion asks, are you worried about an American Civil War?
Yeah, again, it's not I think the probability is very low. I wouldn't lose sleep over it, but the probability is higher than 0%. I know that. And I'm just concerned about social unrest in general. And I always like to encourage people to have a plan B. So I'm always talking about getting a second passport or having residency somewhere outside the United States, a bank account outside the United States. I know that's not realistic for most people.
Right.
So for most people, what I encourage them to do is understand the concept behind having a plan B and having a second passport, but then apply that to your local area.
Right.
So the concept is you can get out of Dodge.
That's
the bottom
my
line.
bug out house.
That's your bug out
That's
house.
my
Or
bug
for
out
most
house.
people, why not just buy an RV?
Right.
I mean, honestly, go to Craigslist, go to eBay. You can get a nice little RV for, let's say, $5,000. Just hook it up to your diesel truck, and then you've got it sitting there right in your driveway, loaded up with food. And then if you don't use it, great. That means there's no downside. You've got your plan B. But then if you feel concerned or if you're not really liking what's going on within a 5-mile radius, let's say, and you got your wife and kids,
Right.
whatever, you just load up into the RV, you drive up into the mountains, and you just sit back and, okay, I'm going to hang out for a couple weeks. I'm going to get out of the line of fire.
Right.
Unfortunately, maybe literally. And, so why not have that plan B? I don't see any downside to it. And that's what I'm trying to encourage my viewers and listeners to kind of think through.
Yeah, absolutely. And I can tell you, we all got a taste of what it could look like in March and April, and it really, and even recently, because there are protests that are happening all over the place.
Yeah.
And I tell my listeners too, where were your holes? Where were you uncomfortable during this period of time?
Yeah.
Get those holes plugged. For me, I had the food, the water, the energy, the security, the barterability, the wealth preservation, the community, and the shelter.
Right.
But the night that I slept with a gun in my bed, I thought, my hole is I don't have a bug out house.
Mm-hmm.
Now I'm working on that, and I'm getting that hole plugged.
Yeah, and a lot of my friends here in Phoenix, I've got a lot of people I know here, and they don't have the means for a bug out house or anything, but they did the same. They bought an RV. And a lot of them just took that, went right up to Show Low as an example.
There you go.
And they just got a space out there with Wi-Fi, and that's what they did back in March.
Yep, it's a great idea. You want to really think about that.
Yeah.
And John Reynolds asks, why the change from dealer to company? I'm not really sure what you mean by that, John, whether I said dealer or I said company, because we're the same. So, does George still, and Jeff Klump asks, does George still have a house in Columbia? And is that a safe place to live?
Yeah, so I've got a lot of properties in Columbia. I've been investing in real estate there since 2015. So I've got a team of people. So I don't know that I'd say I have a house in the sense I don't really have my permanent residence isn't in Columbia. I've just got a lot of investment properties there. So I think what you're getting at, Jeff, is it's got this stereotype because we've all watched Narcos and Pablo Escobar and,
Right.
and all these things.
Right.
So people think that if you go down there, am I going to get kidnapped or am I going to get beheaded or what's going to happen to me? And I can say with 100% confidence that I've been there, like I said, on and off since 2015, and I can promise you, if you went to Medellin, you would feel safer in Medellin than you feel in 90% of the cities here in the United States. Very, very safe place. It's got its bad parts, but even those, I'm very comfortable down there.
That's good. Okay. And James Shemansky asks, Lynette, could you please clarify the reset that you often refer to means a new gold standard? Is this realistic? When I talk about the reset, what I'm talking about is resetting the financial system. But what I also see is that it's a much bigger reset, and that's what we're hearing from the World Economic Forum and the IMF and all these guys.
There's a lot of components there,
It's
yeah.
right. So it's much bigger than that. It's resetting the social structure, the economic structure, and the financial structure. When you're talking about a new gold standard, Do I think we're going to go 100% on a gold standard? No. But history tells us that when all confidence is lost in the currency, in the government, in the central banks, then the way that they get that confidence for you to use the currency again is by putting a component of gold in that currency. And the IMF has talked about it, because I'm guessing that we're going to end up with a local system. Like here, we've got the digital dollars and all of that. It'll still be the dollar, but that's just good locally. I think what is most likely is the SDR, the special drawing rights of the IMF, because that's a basket of currencies.
Yeah.
So it's already more universal. And the IMF has absolutely talked about putting a component of gold in the SDR.
Yeah, I think to your point, they'd have to.
Right.
Because, if you're just backing dollars with SDRs, it's the same fiat currency or same fiat currency system. So if people lose faith in fiat,
Exactly.
they've got to have some sort of backing there. So yeah, that would make a lot of sense.
Exactly. And that's happened over 4,800 times. So I'm thinking that if something's happened the same way that many times, it's most likely to happen the same way again.
Yeah, that makes a lot of sense.
Yep. And Stephen Gould asks, when dollar loses its value, how is that going to affect my mortgage?
Make sure you got it depends if you got fixed rate debt.
Right.
Assuming you got a fixed rate debt, that purchasing power is a transfer of wealth from, or the inflation rather, the loss of value in the dollar, said another way, is a transfer of wealth from the lender to the borrower. So in this case, Stephen, you would be the borrower. So that would be a transfer of wealth, purchasing power from the bank to you. So you're a big cheerleader right now for the dollar going down in value relative to goods and services. The dollar can go down a lot of different ways. And I think people don't specify often enough what they're referring to when they say the dollar going down. Is that the DXY? Is it going down against a basket of currencies?
Currencies, which is meaningless unless you're traveling.
Yeah, right. Or is that going down against asset prices? Is that going down against groceries at the grocery store? Most people forget that in the 1970s, our most famous round of inflation, that the stock market was in a bear market from 72 to 74.
Yes, it was.
So the stock market goes down by 50% or so in nominal terms, while the prices of goods and services are going sky high, you see. So inflation, deflation, there's a lot of nuance to it, to say the least. But what you need to be cheering for, Stephen, I don't know if cheering is the right word, because that would mean that we're in a pretty brutal economy, and so maybe I shouldn't use the word cheering, but what would benefit you is if we do have consumer price inflation and the dollar loses value against other goods and services.
But it only benefits you if you have something that can offset that.
And you have fixed rate debt.
And that's the important. And
so
the
either
fixed
gold,
rate debt.
gold
Exactly.
or fixed rate debt. Yeah, because Stephen, if you don't have fixed rate, if you got a floating or adjustable rate, then what's going to happen as we get inflation, you're going to have to roll over your debt at a higher interest rate. See, and the increase in your purchasing power comes from the delta between the rate of interest you're paying and the real rate of inflation.
Yes.
You see, so let's just say, go back to that original example, where your interest rate hypothetically is 2% and the rate of inflation is 10%. Then there's 8% of purchasing power that's going to you. But if you don't have a fixed rate loan, if you have adjustable, then they can adjust it up to the 10%, if not 12%, and now you're not benefiting from that increased inflation.
Right. And I would say that this is actually the exact same strategy by taking on that fixed rate debt that governments use. That's one of the reasons why inflation is so important to them.
Mm-hmm.
Because they get to pay it back with dollars that have less and less value.
That's right.
And that's really what the reset is. It's resetting all the debt with currency that has no value.
Yeah, and look at our debt to GDP in the 70s.
Yep.
The U.S., right off the top of my head, I can't recall what it was to start, but I'm guessing it was around 60% in 1970, and right around there, maybe 60, 70%. And then by the time we got to 1980 or so, the debt to GDP was only about 30%.
Right. But what was also happening in the 70s? Because I don't think you were alive then,
Oh,
but
yeah,
I
yeah.
was. No, you're not as old as I am.
No, I was alive in the 70s.
Oh, okay.
Yeah, but we had the
You were
inflation.
itty bitty.
Yeah, I was itty bitty. But
Now
yeah.
you're really tall.
Yeah.
But we were resetting the currency.
Yeah, right.
And we went, from a quasi-gold standard anyway.
Yeah, 71.
Right. To a pure debt standard.
Mm.
And what that really did was hand over control of inflation directly to the central banks.
Mm. Right.
And what do central banks know? They know debt.
Yeah, yeah, right. And
You know?
Yeah, yeah,
So,
yeah.
and Blue Lion asks, how likely are bail-ins that will take insured money out of the bank?
I think very unlikely. Very unlikely. Now, I'm not saying that bail-ins aren't unlikely. And let's be honest. What's inflation? I mean, that's a bail-in, right?
Well,
Or they're
yeah.
basically stealing your purchasing power of your cash that's held in the bank. So I would consider that a bail-in. But it's like
Yes.
a
And
default
inflation
almost.
itself is reset. It just happens, more slowly.
Yeah, yeah. But if you're talking about FDIC insured stuff,
That's what they're talking about.
I would be shocked. I mean, I'm not saying it's totally impossible, but that would be. I think
Well, they
that
tested that in Cyprus. And in Cyprus, when they did the
Yeah.
bail-in in 2013,
their insured stuff was still there.
But at first, no. When they were very first doing the bail-in, they just took everybody's money that was in the bank.
Mm.
And then there was a global outcry from it. Wait, what about deposit insurance, which was created in the 30s to get you to keep your money in the banks?
Right, right.
Right? So it is a scheme, and I think he's also probably saw the piece that I recently did where, periodically I look at the DIF balance, the deposit insurance fund,
Oh.
to see how much is, in there for
You
the
compare to
insured
deposits?
deposits.
Yeah,
Right.
right.
And it's like a little bit more than a penny to insure every dollar.
Yeah, last time I looked, it's like 150 billion that the FDIC actually has to insure over 9 trillion.
Exactly.
Of deposits.
It
So,
really is
good
a
luck
joke.
with that.
But, to really answer that, they did test that in Cyprus, and when there was that global outcry, then the BIS came out with a report like in June, so a few months after that, and they have these beautiful graphs on what it would look like over the weekend. The first graph, I thought this was interesting, the order in which they did this. Graph number 1 showed a bail-in without insured deposits, so just taking everything.
All right.
Graph number 3 showed what it would look like with insured deposits. So I do think that they will most likely honor the insurance because they've already tested it.
Yeah, and even if they did, I think the Fed would step in and just bail out the banks again before they
probably,
would.
so they print money.
Yeah, so they
You know,
print more bank
so they print
reserves,
money, but
and
I mean,
they buy
what
quote
is
unquote
it?
assets, and I think we just go through a round of that game again until the people were made whole. I think
Right.
that's, and I'm not saying that's going to happen.
Well,
I'm
nominally
saying,
made whole.
Yeah, right. I'm just saying that's, in my opinion, that would be the most probable outcome.
And I would agree with that because they tested it and they already found out that's probably not a good thing to
Yeah,
do.
especially when we've got all this social unrest right now, as it is. I mean, can you imagine if they did a bail-in here for people that were just the average Joe and Jane? I mean, oh my gosh.
No. But
Yeah.
there were almost as much uninsured deposits in the bank as there were insured deposits in the bank. So, and all that would be bailed in.
Yeah, now that said, if you have over the amount, then I would definitely think about another place to store your purchasing power, or I like to call it dry powder. Like if you're one of these people that's saying, okay, listen, I want some dry powder right now because I think the stock market's going down, or maybe the real estate market, and then if you've got over whatever 250,
250,
then I would definitely consider opening up another account or taking
In a
that
different
dry
bank.
powder out and putting it somewhere. I mean, it sounds crazy,
like
but like
gold.
short-term T-bills. Well, gold.
Well-
I like gold as far as an insurance policy.
Right.
I just hesitate a little with the short-term dry powder because you've got a cross reference there that might kind of get screwed up a little bit. As an
Yeah, it
example, if we have
depends
a
on the
quick-
timing,
Yeah,
right?
exactly.
It depends on what you're going to do and what your timing is. It's not a short-term thing.
Yeah.
But that kind of leads me to a question that Eric and I got earlier on if you say that gold is going up, why only 10% of your investments in gold? Because I'm definitely all in. I'm way more than 50%. I'm all in.
Yeah. Well, number one, because I don't think anyone knows the future definitively. That's number one. And I think that's the easiest thing the average person can do, that meaning diversification.
Mm-hmm.
And I don't look at gold as an investment. I don't even look at it as a speculation. I just look at it as insurance.
Mm-hmm.
So the way I like to set up my portfolio is I've got 10% allocated to gold. That's my insurance policy. That's not to get you rich, it's just to stay rich,
Mm-hmm.
right? Or
Right.
just maintain your purchasing power, really.
Mm-hmm.
Then I like to do 80% of stuff that pays me to own it. And kind of the reason I'm like this, it's what forms us is not only the successes we have, but maybe more so the mistakes we make.
Yes, exactly.
And I've made a lot of money as an investor, but I've also made some very, very big mistakes, some stupid stuff. And one of the biggest mistakes I made is I bought land that didn't have anything built on it as a speculation because I just thought the price was going up, right? And that land doesn't pay me to own it, and it doesn't have any liquidity.
Right.
So now I've got these, hundreds of thousands of dollars locked up in this land that I can't sell, and I don't really want to fire sell it, take a 50% haircut. Now, if I had a property on that land that was paying me to own it, then I wouldn't care.
It's different, right?
I wouldn't care because I'm
Right.
getting all this money every single month coming into my back pocket. So so I have leverage. The buyer doesn't have leverage over me because I'm not in a position where I have to sell it. Right. And so that's why I love gold, but I wouldn't want it in my entire portfolio because I like being paid to own stuff. And especially if you're someone that, like when I first retired as an example, I looked at my monthly expenses and said, listen, I never want to draw, regardless of what happens in the market or what happens with my investments or what happens with gold or silver or whatever, I never want to have to draw down my savings. That's priority number one.
Yes, right.
So in order for me to never have to draw down my savings, I have to create X amount of cash flow coming in every single month. Then I can go ahead and worry about setting up a portfolio that I think is going to go up tremendously in value over the next 10 years. But I got to cover my bases first and foremost. So that's what takes me back to why I have so much of my portfolio invested. It doesn't just have to be rental properties.
Right.
It can be dividend-paying stocks, and it can be dividend-paying stocks outside of the United States.
Yes,
and I understand there's definitely counterparty risk there, and you're inside the system. So I don't like that part of it at all. I'll be the first one to admit. But that's why I've got the insurance policy. And I think everyone can adjust it to what helps them sleep well at night. If you're a 10% person, great. If you're a 50% person, that's going to help you sleep well, then so be it. If you're a 100% person, the same thing. But I think the bottom line is you have to know why you're owning the asset. So many people get them confused with their portfolio. And I think it's all about portfolio construction. And that's the part that most people completely ignore. They just try to figure out what's going to go up or down in price.
Right.
Right?
Right, nominally.
Nominally, right. But if you've got to understand that, like if you're owning gold for XYZ reason, you got to make sure you're doing your research and watching YouTube channels like yours to know, okay, this is why I'm owning gold, not just because I think it's going to go up in price.
Right, because I don't even care about the price.
Yeah, exactly.
Personally.
It's all about these other things and educating yourself as to why you own it. And so if you can do that with not only gold, but whatever else is in your portfolio, I think you're going to be much better off long term. You're going to make better decisions. And the most important thing is with that portfolio construction, you're going to hopefully eliminate as much emotion to the decision-making process as possible.
Right.
Because you start off as a stockbroker, so you understand that the biggest flaw that we have as investors, whether you're investing in gold, Bitcoin, the stocks, bonds, it doesn't matter, is human emotion.
Yes.
That's
and you marry it.
That's right.
You can't marry it. You can't marry anything.
That's right. You get married to a narrative.
Right.
And you stick with it, and then you get crushed, So the more you can eliminate emotion, the better. And I think that goes back to that portfolio construction and understanding the true reason why you own each and every asset.
Exactly. That's great. I wish we had more time because we do have more questions. But we need to wrap this up because I
Okay.
know you have other places to go. So, and I hope we can do it again.
Yeah,
Maybe
yeah,
I'll do
yeah.
it for you or whatever because
Yeah.
he's going to be here for a while. I'm so excited.
I am.
And we've got some things that we're talking about.
Tons of content.
Tons
of
and
content.
tons. So I'd like to thank all of you for joining us today in this impromptu kind of meet
Yeah.
and greet and
Thank you, everyone,
conversation.
for
This is
joining us.
Great. And I've just loved having you in the studio. Doing it live, it's just a different energy level. And it's a lot more fun.
It's more conversational, and I think it just brings everyone into a typical conversation that you and I would have. I mean, even when we were at your
Right.
place and you were showing me around, it was fantastic. But afterwards, we sat down at your dinner table and just went back and forth, just the two of us, for probably an hour, if not longer, talking about these exact same things.
Exactly.
And believe it or not, guys, this is exactly what we talk about even when the camera is not on.
Which is that
we
we are
obsess
so
over
nerdy.
this stuff. Yeah, that's right.
Well, I hope you got as much out of this and enjoyed it as much as I do. And just remember, it is absolutely time to cover your assets.
Mm-hmm.
And here we like to use the well shield. And
Okay.
two components of that are physical gold and
Yep.
physical silver.
Yeah, that's right.
So if you like this, please give us a thumbs up. Hit that bell below. We'll let you know when we're going releasing another video. And until tomorrow, please be safe out there. Bye-bye.
Bye, guys.